Imagine, just for a moment, that you've held assets overseas, undisclosed assets, perhaps for years. You're walking this kind of fine line, financially speaking. Then suddenly the government offers a deal, a chance to wipe the slate clean, bring everything into the open. What would that actually look like? Today we're doing a deep dive into a really fascinating piece of legislation, the Exchange Control Amnesty and Amendment of Taxation Laws Act 12 of 2003. Yeah, it's a bit of a mouthful, I know, but it truly represents a pivotal moment in the country's financial history.
It absolutely does. And what's really compelling about this act, I think, is its dual nature. This wasn't just about offering an amnesty like a simple get-out-of-jail-free card. It was more of a comprehensive financial package.
Okay, so two sides to it.
Exactly. The act had two distinct but actually deeply interconnected goals. First, providing that clean slate for past mistakes, specifically related to foreign assets and exchange control violations. And second, at the same time, it was adjusting a whole spectrum of taxation laws. It's a prime example of government using a multi-pronged approach to tackle some pretty complex financial issues head-on.
Right. So our mission today is to really unpack this act for you. We want to explore its core purpose, get into the key provisions, understand the legal background, why was it even needed, and then look at its lasting significance. What did it actually do in the real world? We'll aim to make it clear and engaging, whether you're just curious about this bit of history or maybe you're a law student looking for deeper insights.
And just to give you a sense of the timing, the act was signed into law late May 2003 and came into effect almost immediately. Bang. But it wasn't just, set in stone then. It was a living document, actively reviewed, updated over the next couple of years, which really shows it was responding to ongoing financial stuff as it happened.
Okay, so with that context, let's zoom in a bit. What was the real driving force here? What problems was this comprehensive act trying to solve? We're talking about long-standing issues, right? Exchange controls, tax compliance, and let's be honest, quite a bit of undeclared wealth sitting outside the official system.
Precisely. For many years, like a lot of countries actually, there were very strict exchange control regulations, rules about moving money in and out, and often, maybe because of economic uncertainty or political reasons, people and companies, well, they broke those rules, sometimes intentionally, sometimes maybe not. This act specifically targeted those situations. The government had clear goals spelled out right there in the preamble.
Okay, what were they?
Well, first, to enable violators, people who'd broken exchange control rules or tax laws like the Estate Duty Act or Income Tax Act, especially concerning foreign assets, to basically regularize their affairs, come clean, get back in line. Second, they wanted maximum disclosure. Find out what foreign assets were actually out there and, crucially, encourage people to bring that money back, repatriation. And third, linked to that was extending the tax base. By bringing all this previously hidden foreign wealth and income into the system, the government aimed to, get more people and assets contributing to national revenue.
What's really interesting there is it wasn't just about punishment. It sounds much more like a strategic offer, a kind of carrot designed to bring assets home and capture lost revenue, but giving a legal way to do it.
That's a great way to put it, a strategic carrot.
Okay, so let's dive into the amnesty itself, Chapter 1, this second chance. Who exactly qualified for it, and what did they actually have to do?
Right, the amnesty was pretty broad. It targeted residents as of a specific date, February 28, 2003. This included individuals, natural persons, and, interestingly, even deceased estates could apply. Also, certain business structures, like close corporations, sort of simpler companies and trusts. The key was that they had to hold foreign assets derived either from unauthorized assets.
Meaning assets got overseas, breaking the exchange control rules?
Exactly. Accumulated or transferred out in contravention of those regulations. Or the assets came from undeclared income. Income that should have been taxed but wasn't. And it also looped in people called facilitators.
Facilitators?
Yeah, individuals or related parties who had actively helped someone else accumulate or transfer these illicit foreign assets. We're talking beyond just giving basic advice, actual assistance.
Okay, that's quite specific. And you mentioned some crucial definitions earlier, foreign asset, unlawful activity. Can we clarify those a bit more? They sound key.
Absolutely vital. A foreign asset was defined pretty broadly: funds in foreign currency, any kind of asset transferred from or built up outside the country. But there was an important exclusion: foreign bearer instruments. Think anonymous bonds or certificates. Those were excluded unless the owner could prove the funds behind them were held for, I think, 18 months or more. It was trying to stop easy laundering of untraceable money.
Gotcha. And unlawful activity. That sounds like a potential minefield.
It was critical. The act specifically excluded serious crimes defined in the Prevention of Organized Crime Act, things like drug dealing, racketeering, that sort of stuff. So the amnesty wasn't for, major criminals. But crucially, it did include exchange control contraventions and failures to comply with tax acts. So it drew a clear line. This amnesty is for financial rule breakers, tax evaders, not for those involved in serious organized crime.
That distinction really clarifies the government's focus. And you mentioned special rules for discretionary trusts. Those can be tricky structures.
Yes, that was a clever bit of transparency tucked in there, Section 4. It allowed donors or beneficiaries of non-resident discretionary trusts an option. They could choose to have the trust's foreign assets if those assets were originally donated and came from unauthorized sources or undeclared income before that Feb 2003 date deemed legally as their own personal assets. It was a way to pierce the veil of the trust, essentially, for the purposes of the amnesty and bring those hidden assets into the light.
Makes sense. So if you figured out you were eligible, what was the actual application process like? What did you have to submit?
There was a specific time frame, a window, June 1st, 2003, running through to February 29th, 2004, so about 9 months. The core of the application was a sworn affidavit or a solemn declaration, a formal statement. In it, you had to disclose the market value of the foreign asset in its foreign currency as of that February 28th, 2003 date. You also had to describe it, say where it was located, and critically provide proof of its value, things like valuation certificates, bank statements, something concrete. And of course, you had to formally confirm that none of the assets came from those serious unlawful activities we talked about.
And managing all these applications, there's a specific body set up for this, right? The Amnesty Unit. Sounds pretty important.
Absolutely central to the whole operation. The Amnesty Unit, sections 22 to 27 cover this. It was designed as an independent body. It had a chairperson appointed by the Minister of Finance, and then at least 4 people each from the South African Reserve Bank, RR, and the South African Revenue Service, SARS. Its job was basically to evaluate every application, check if it met all the rules, and then make the call, approve or deny, designed for impartiality.
Okay, and what were the criteria for approval versus denial? Were there things that would immediately get an application thrown out?
Pretty straightforward, actually. For approval, you had to tick all the boxes. Full disclosure, applied within the time frame, and confirmed no serious unlawful activities involved. Simple as that, on paper. Denial, though, could happen for a few reasons, applying too late, obviously, or, and this is important, if SARS or the Reserve Bank had already started an audit or investigation into you before you submitted your amnesty application. Unless they later dropped that investigation, you were likely out of luck. And naturally, if it turned out the assets were from serious crime, that was a definite no. Oh, and one other thing. If you were applying for the tax relief part, you could be denied if you hadn't filed your regular income tax return for the year ending Feb 28, 2003.
Right, so basic compliance was still expected. Now, if you did get approved, what did this clean slate actually cost? Because it wasn't free, was it?
No, definitely not free. There were levies involved. 2 main ones. First, the Exchange Control Amnesty Levy. This was charged on the leviable amount, basically the total market value of the foreign assets you declared, minus any legitimate assets or unused allowances you might have had. And here's where the incentive came in. The rate was 5% of that amount if you repatriated the funds, brought them back into the country within 3 months of getting approval.
Only 5% if you brought it back.
Right. But if you chose not to repatriate, to keep the assets offshore, the levy jumped to 10% on that remaining leviable amount, a clear nudge to bring the money home. Payments went via authorized dealers, converted to rand, and then into the National Revenue Fund.
Okay. And the second levy?
That was the Domestic Tax Amnesty Levy. This was simpler. A flat 2% rate on the value of the previously undeclared domestic amounts that were, used to acquire foreign assets or just never reported. These were calculated based on the rand value at the time they were accumulated or converted. Similar payment process.
And in return for paying these levies, that's when you got the real relief, the actual clean slate.
That's the core benefit, yes. Sections 14, 15, 17 spell it out. If you were approved and paid up, you were legally deemed not to have contravened the exchange control regulations. And you were also deemed not to have committed offenses under the Income Tax Act or the Estate Duty Act, specifically concerning those assets and amounts you disclosed in the amnesty. It really was a fresh start for that specified period. Huge peace of mind for those who took it up.
But like any deal, there were probably some terms and conditions, some limitations on this relief.
Oh, absolutely. Very important limitations. This wasn't a get-out-of-jail-free card for all taxes forever. The tax relief specifically did not apply to things like normal income tax or secondary tax on companies, STC, donations tax, or estate duty for tax periods ending after the cutoff dates, mostly Fed 2002 or Feb 2003, depending on the tax. Basically, it cleaned up the past, but your future tax obligations remained firmly in place. You still had to pay tax going forward on income from those assets. Also, no relief for taxes you'd already paid or disclosed before applying. And you couldn't then turn around and claim deductions or allowances related to the amounts you got amnesty for. No double dipping.
Okay, that makes sense. What if something went wrong after approval? Could the government take it back? Could the approval become invalid?
Yes, there was a provision for invalidity of approval, Section 20, and approval could be voided under certain circumstances. For example, if you got tax relief, but then failed to submit your normal 2003 tax return by the deadline, that could invalidate it. And crucially, if it was later found out, despite your declaration, that the assets actually did come from serious unlawful activities, the approval would be voided. And in that specific case, you wouldn't get your levies back either. A serious consequence for lying.
So, a safety net for the revenue authorities.
Mhm.
But what about the applicant? If your application was denied unfairly, did you have any recourse?
Yes, definitely. The Act included a clear right to objection and appeal, Section 21. If denied, you could first lodge an objection with the chairperson of the Amnesty Unit. If that didn't work, it could go to a special review panel. And if you were still unsuccessful, you had the right to appeal the decision to the tax court. So there was a process for challenging a denial.
Okay, so that covers the amnesty quite thoroughly. But you mentioned this act had two sides. Chapter 2 deals with broader tax changes, right? Affecting everyone, not just amnesty applicants.
Exactly. This is where we see the Act wasn't just about the past, but actively reshaping the current financial landscape. It shows that broader governmental strategy. There were several key changes. For instance, transfer duty on property purchases was adjusted. The threshold where you paid 0% duty was increased, making buying cheaper properties a bit more affordable for individuals. That kicked in from March 2003.
Small relief, but noticeable for first-time buyers, maybe? What else?
Normal tax rates were fixed for the upcoming tax year, ending Feb 2004. For individuals, it set those progressive rates we mentioned starting at 18% and going up to 40% for higher earners. Trusts, unless they were special trusts, got hit with that flat 40% rate. Companies generally paid 30 cents on the rand. But importantly, there were special lower rates for small business corporations, only 15% on the first chunk of profit, then 30%. And some specific industries like gold mining had their own rules.
And you mentioned amendments to the Maine Income Tax Act of 1962 itself.
Yes, several significant ones. The definition of resident was tightened up, effective pretty quickly in Feb 2003. It basically stopped people playing games with double tax agreements to avoid being resident anywhere for tax purposes. There were also welcome increases in the tax rebates. The primary rebate went up, giving everyone a bit of tax back. The secondary rebate for people over 65 also increased slightly, and the exemption threshold for interest and foreign dividends was raised, so you could earn more interest or foreign dividends tax-free, particularly beneficial for older savers.
Boosting savings, perhaps. Anything else major in the Income Tax Act?
Yes, a big one for entrepreneurs. The income threshold for qualifying as a small business corporation was boosted significantly from R3 million turnover to R5 million. This meant more businesses could access those lower tax rates and other benefits. That was from April 2003. Oh, and a technical but important change regarding secondary tax on companies, STC. It became payable if a company stopped being a resident. This closed a loophole where a company might shift residency just before paying out big dividends to avoid the tax.
Okay, lots of adjustments there. But you hinted earlier at something even more fundamental, this interagency information sharing. That sounds like the real game changer.
It really was. This theme runs through several sections, 34, 39, 46, 48. Amendments were made not just to the Income Tax Act, but also the Customs and Excise Act, the Reserve Bank Act, and the VTAT Act. What they did was authorize, for the first time really explicitly, the disclosure of taxpayer information between the Commissioner of SARS and the Governor of the Reserve Bank or their officials. This was specifically for exercising their powers under exchange control regs or the various tax acts. It effectively broke down the traditional secrecy walls between these key financial regulators.
Wow. So SARS could tell the Reserve Bank about suspicious income, and the Reserve Bank could flag weird foreign exchange movements to SARS.
Essentially, yes. It created a much more integrated enforcement environment. This wasn't just about catching past cheats. It was about building a system where it was much harder to hide illicit financial activity in the future. A massive shift towards transparency and coordinated oversight.
Beyond income tax, were there other changes that people would have felt more directly, maybe as consumers or in specific sectors?
Yes, a few noticeable ones. Under the Customs and Excise Act, the air passenger tax for leaving the country went up by 10 Rand to R110 from July 2003. And the usual suspects. Excise duties increased on things like beer, wine, spirits, tobacco, a standard revenue-raising measure, often called sin taxes. The Stamp Duties Act saw some tweaks too, including getting rid of stamp duty on certain documents from April 2003, which might have simplified some processes.
Any relief for smaller businesses?
Yes. Under the Value-Added Tax Act, the turnover threshold for commercial accommodation, I think small B&Bs, guest houses, was increased from R48,000 a year to R60,000. This meant more small operators wouldn't have to register for and charge VAT, reducing their admin burden. And finally, something positive for retirement planning. The Tax on Retirement Funds Act saw the tax rate levied on the investment income of retirement funds actually reduced quite substantially from 25% down to 18%. That was effective March 2003.
Okay, so looking back at this whole package, the amnesty, the tax tweaks, the information sharing, it really paints a picture of a government trying to get its financial house in order on multiple fronts. What's the lasting significance? What does this act tell us?
Well, connecting it to the bigger picture, you have to see it in the economic context of the time. Post-transition years, trying to stabilize the economy, deal with capital flight, and definitely needing to broaden the tax base. The act basically acknowledged, quite openly, that a lot of wealth was simply outside the formal system, and it used that classic carrot and stick approach you mentioned. The amnesty was the carrot. Come clean, pay a levy, and we'll wipe the slate clean for past transgressions.
And the stick.
The stick was everything else. Tighter regulations, like the residency rules and STC changes, but most importantly, that information sharing between SARS and SARBA. That was a clear signal. The walls are coming down. Hiding money is going to get much, much harder. It dramatically changed the compliance landscape. This commitment to transparency and enforcement was a landmark move. It really signaled the end of an era of relative financial opacity.
And the impact on individuals and the economy.
For those who took the amnesty, it undoubtedly offered real peace of mind. The ability to bring assets back legally, invest them openly, plan estates without fear. That's significant on a personal level. For the economy, the goals were clear. Bring in immediate revenue through the levies, encourage repatriation of capital that could then be invested domestically, and, crucially, broaden the long-term tax base by having more assets and income declared in the future. How successful it was in each aspect is, of course, debatable, but the intent was clear.
It really drives home how legislation like this isn't just about collecting tax. It's a powerful tool governments use to manage, to shape, even to try and influence the financial behavior of an entire nation. It's like a snapshot of that moment, drawing a line in the sand for a new era of financial accountability.
So, wrapping up this deep dive, we've seen an act that was really quite bold, a two-pronged strategy, offering forgiveness for the past with the amnesty, while simultaneously tightening the screws and strengthening the foundations of tax and exchange control law for the future.
It really was. And looking back, it leaves you with a fascinating question, doesn't it?
Well, you have to wonder, what was the primary success of the exchange control amnesty? Was it truly about getting large amounts of money repatriated back into the country? Or was its biggest, maybe longer-lasting impact simply in expanding that tax base over time and, perhaps more importantly, signaling that new era of information sharing and stricter enforcement? Did it change behavior more than it recovered capital? And thinking even broader, how does offering an amnesty like this affect public trust? Does it encourage future compliance because people see a chance for a fresh start? Or does it perhaps signal that non-compliance might eventually be forgiven? What are those long-term trade-offs? It's definitely something interesting for you to ponder.